Welcome to the session on working capital management. Today I am going to provide you a comprehensive overview of the subject working capital management. Today I am going to discuss with you the topics introduction, financing current assets, cash management, receivables management, inventory management. Before discussing the subject, I want to share with you few informations about the subject. Working capital management subject is very easy subject. Okay, this paper is problem oriented paper, but the proportion of theory in the question paper you can expect 40% of theory questions and 60% of problems. Okay, so students, please try to achieve center marks in this subject. Okay, because the problems are very easy. You can solve the problems with the formulas. Okay, there is no rules, provisions and comprehensive statement preparation. So you can aim for centum in this subject. And I also want to share few tips to pass in the examination. Okay, so this subject is problem oriented paper. Okay, any problem oriented paper, in each unit they will ask you two mark questions. Okay, so out of these 5 units you have to attend 10 2-mark questions. In the problem paper, each unit, if you go through the previous year question paper, you have only few important questions, at least 10 repeated questions. So totally you have only 52-mark questions. If you properly revise those 52-mark questions, you can get 20 marks easily in the section A of the question paper. Okay, and for problems, okay, even if you don't know the problems, if you attend the format correctly, if you write the formulas, you will get step marks. Okay, so even if you don't know how to solve the problem, you try to attend the formulas and give the statements properly, so that you can get step marks and you can easily pass in the subject. Okay, this is the important tips I want to share with you. Okay, next we will go to the subject. Okay, first the concept, introduction to the working capital. Okay, before explaining the meaning of working capital, what is capital? Capital is the money invested in the business. Okay, for every business requires two types of capital. One is fixed capital and another one is working capital. We use every business organization use the fixed capital for what purposes? To buy land and building, machinery, and they use that money for capital money, fixed capital money for expansion of the business. Okay, this is the purpose of fixed capital. And the another one is working capital. Now let me explain what is this working capital. Working capital is the part of the capital which is required to run day-to-day expenses of the business. What are the day-to-day expenses of the business? Purchase of raw materials. Okay, every business has to purchase raw materials to manufacture the product. Then they have to pay wages. They have to spend for salaries, advertisement, and these are the day-to-day expenses that a business has to meet. And for these expenses, the capital required is called working capital. Okay, so which money we are using for this working capital purpose. Okay, so working capital purpose, we use short term, that is current assets. Okay, the investment in current assets and short term assets we are using for working capital purpose. Okay, and the fund invested in current assets keep revolving fast. Okay, and they are easily convertible into cash. That is why we can say working capital as revolving capital, because the current assets are revolving fast. We can call it as circulating capital because the money is circulating. Okay, and we can also call this working capital as short term capital. Okay, here you have the formula for working capital. Okay. So that is working capital is equal to current assets minus current liabilities. Current assets minus current liabilities. Working capital measures the financial health of the business. Okay. And it measures the liquidity of the business. Next, what is working capital management? You should know what is working capital management. It is the process of managing a company's short-term financial assets. Okay, that is why it is called working capital management. Next, you should know what are the current assets and current liabilities. You are all depending on account stream. So, you know very well what are current assets and what are current liabilities. Current assets examples are debtors, bills receivable, prepaid expenses, cash in hand, short-term marketable securities, inventories. And the example for current liabilities are creditors, bills payable, outstanding expenses, bank overdraft, short-term liabilities and provision for taxation. Okay. Next, what are the significance of working capital? Significance means importance. Okay, why? What type of importance it is? First one is strengthen the solvency. Okay, how it's solvency means easily convertible into cash. Okay, that is the ability of the company to meet its obligations. Solvency means ability of the company to meet the obligations. Okay, whether the company has sufficient asset and resources to cover the debt commitments. Okay, that is called solvency. If the company has proper working capital, it strengthens the solvency of the business. Next, if the working capital is managed properly in the business, it enhances the goodwill of the business because the customers are satisfied and those who are related to the company, they believe in the company. That is called reliability. Okay, so it increases the goodwill of the business and easy obtaining of loan. Okay, if the company is financially strong and they are able to meet their working capital requirements, their credit worthiness will improve. So the banking, the financial institutions, they easily provide loan to the business organizations if they approach for loan. Okay. Then next one, regular supply of raw materials. Okay. The company is financially strong. Okay. So the suppliers will ready to supply the raw materials. So the company need not bother about the supply of raw materials. They will get supply of raw materials regularly. And it increases the morale of the employees also. If the company is financially strong, it increases the morale of the employees. And we can conduct the business operations smoothly. There is no need to worry about the working capital. So we can operate the business easily. And the business organizations can provide cash discounts to the credit debtors. Okay. Next, working capital, types of working capital. We can classify the working capital on the basis of concept and on the basis of time. On the basis of concept, the working capital is divided into two, gross working capital and net working capital. What is this gross working capital? Gross working capital, it is the total of current assets. Net working capital. Net working capital is the difference between the current assets and current liabilities. Okay. Then on the basis of time, we have permanent or fixed working capital and temporary or variable working capital. From the name itself, you can understand the meaning of working capital. A particular amount of money is required temporarily for the running of the business, smooth running of the business. That part of capital is called fixed working capital. And variable working capital, it means that some particular amount of capital, it does not need regularly to the business. It depends upon the situation. We need some extra amount. That amount of capital, it is called variable working capital. And again, the permanent fixed working capital is divided into regular working capital and reserve working capital. Temporary working capital is again classified into seasonal working capital and special working capital. Next, we are going to discuss about the factors affecting working capital. Okay, what are the factors determining the working capital? The first point is nature of the business. What type of business they are doing. That indicate the working capital requirement of the company. For example, if the company involved in manufacturing of the products, they require more capital. To manufacture the product, they require raw material, labor. For that, they have to spend a regular day-to-day expenses amount. So, they need so much of working capital. Suppose if the company involves in trading business means just they buy from someone and they sell the product, okay. They need not produce the product once again. So, nature of business determine the working capital. The trading concerns don't need that much of working capital, okay. Then next one, the production policy of the organization determine the working capital. What is the production policy? For example, if the company adopt the policy of manufacturing goods using machinery, okay. If they use machinery, they don't need much labor, okay. Labor force is not needed. So, we need not pay the wages to the labor. So, that working capital they don't need. So, the requirement of working capital is less if the company adopt using machinery. If they go to prefer labors, they have to pay wages, okay. So, the production policy of the company determine the working capital. Length of the production cycle. Length of the production cycle means the time required to produce the product, okay. If the production cycle is very length, the working capital requirement is also high. If the production cycle is small, the company don't need that much of working capital, okay. Then business cycle. Business cycle means sometimes the business face boom period. Boom period means the business is successfully running. They have to sell more products. That time they have to produce more products, okay. So, they need more working capital. If the business is dull, that is depression period. During the depression period, the selling of product in the market, the demand for the product is very less. So, they don't need much working capital. And operating efficiency. Operating efficiency means how the business manage the working capital, okay. How they control the cost of the business. How efficiently they run the business. That factor determine the working capital. If they operate efficiently, they don't need much working capital. Growth and expansion of the business. In the initial stages, the business don't need that much of working capital. Once if they achieve the growth stage and they plan to expand the business, they need more working capital. Seasonal variations. Seasonal variations means, for example, during the rainy seasons, if they belong to the umbrella producing company, they have to produce more umbrellas during the rainy season. That time they need more working capital, okay. So, that factor determine the working capital. And this slide presents the other factors which are determining the working capital. Next one, we are going to next we will discuss what is operating cycle, okay. And the operating cycle we can classify whether the company is manufacturing firm or trading concern. Here we have the picture of operating cycle of a manufacturing firm, okay. What is this operating cycle? That is the time length required to convert cash into cash, okay. For here I will explain you what is this. The business has cash. They buy raw materials. After buying raw materials, it's subject to production process, okay. Then next is work in progress stage. At last, the stage is finished goods. Once the production is over, that is going to the market for sales, okay. When they sell the product, if they sell it for credit, that is debt, okay. We have debt collection period. If the company recover that debt amount, once again it is converted into cash. Okay. So what is the time required to convert this cash into debt collection? That is called operating cycle. This is the operating cycle for manufacturing firm because they have to buy raw material, work in progress. Next we will see what is the operating cycle of trading firm. Okay. So here they need not manufacture the products. Okay. So with the cash they purchase the finished goods. They purchase from outside. Okay. They are not going to manufacture any product. Once they purchase the goods, they are going to sell the goods. Okay. If they sell it for credit, that is called debtors. Okay. So that debtors, if they pay the amount, it is converted into cash. Okay. So trading concern operating cycle is a very simple cycle. Okay. Next we will see how to calculate this operating cycle, and I want to remember you what are all the concepts we have discussed here. These are all the important questions. What is working capital? What is working capital management? What is operating cycle? These are all repeated 2-mark questions. Okay, you please concentrate in these 2-mark questions. You will secure good marks. Okay, and this is problem oriented. How to calculate operating cycle? Raw material storage period plus work in progress holding period plus finished goods storage period, debtors collection period minus creditors payment period. This is the formula. I already told you. Please remember the formulas. Okay. If you write the formulas, you will get step mark. Okay. Don't forget this formula. Next, how to calculate? We have raw material storage period in the formula. We have work in progress holding period in that formula. Yes, how to calculate this raw material storage period? Raw material storage period is equal to average stock of raw materials by average cost of raw materials consumed per day into 365. Okay, and if you go through the all this formula, please go through this formula. Here everything is average cost. Okay, so divided by average cost. For raw material storage period, write average cost of raw material because it is related to raw material. Next one, work in progress. For work in progress, average cost of production, because here the production is going on. How to remember this formula? Very easy. For raw material, write raw material. Work in progress is related to production. So write average cost of production. Finished goods storage period. Okay. So here you have to divide by average cost of goods sold per day. Okay. The next one, debtors collection period. Debtors means credit sales. So divide by average credit sales. Creditors it is related to purchases. So you have to divide by average credit purchases. Okay. So you can remember this formula very easily. All you have to divide by average cost. Okay. And in the numerator, if you go through the numerator, where average stock of raw material, average stock of work in progress, everything related to stock only, average stock of finished goods. Okay. Then next we will see the format for working capital requirements. Okay. This is a very important 10-mark problem. Even if you don't know how to solve the problem, please write the statement correctly. Okay. How to prepare this working capital requirement statement? You should remember the formula for working capital. Already we have discussed the formula for working capital. Working capital is equal to current assets minus current liabilities. Remember that formula. Okay. So look at this statement. First part of the statement is current assets. In the current assets, we have all the related current assets information. Okay. So inventories, raw material, work in progress, debtors, bills receivable, all these current assets. Okay. Total this current assets. Okay. So and I already told you what is gross working capital. Gross working capital is total of current assets. Okay. Next we will see what are the current liabilities. Find out the current liabilities total. Then at last you find out the net working capital, that is current asset minus current liabilities. Okay. It is very easy to remember. If you remember the formula for working capital is current asset minus current liabilities. Okay. Next, we will move to the next unit. The next unit topic is financing current assets, and in this unit you have only theory questions. Two important questions you can expect in the question paper. Okay. The first question is approaches to financing current assets. Okay. There are three approaches to financing current assets. The first approach is aggressive approach to working capital financing. Okay. And what is this aggressive approach to working capital financing? The company decide to financing short-term finance. Okay. And this short-term finance utilized not only to temporary working capital but also reasonable part of the permanent working capital. The company's decision is they want to use the short-term assets for both temporary and permanent working capital, and here we have advantages and disadvantages of aggressive approach of working capital. What are the advantages of aggressive approach? Low financing cost and high profitability, lower carrying and handling cost, highly efficient working capital management. And what are all the disadvantages of this aggressive approach of working capital management? Insolvency risk, lost opportunities and unexpected shocks. Okay. And the next approach to the working capital financing is conservative approach. What type of approach the business organization adopt? In this approach, a company adopting higher level of current asset and higher working capital. They adopt higher level of current assets. Okay. And their strategy is long-term sources will finance the temporary working capital and short-term funds will finance the temporary working capital. In the first approach, both the permanent and temporary working capital is financed by short-term assets, and here only the long-term sources used for temporary working capital and short term is used for temporary working capital. And the advantages and disadvantages of this conservative approach: smooth operations with no stoppage, no insolvency risk. And what are all the disadvantages of this conservative approach? Higher interest cost, idle funds, higher carrying cost, inefficient working capital management. And the last approach, third approach to the working capital financing current assets, maturity matching in working capital approach. What type of strategy the company is adopting in this approach? Okay, so the working capital financing wherein short-term requirements are met with short-term funds and long-term requirements are met with long-term funds. This is the approach in maturity matching approach. Okay, so permanent assets financed with short-term financing and temporary assets financed with long-term financing. This is the approach, maturity approach. Next, we will see what are the committees framed, set up for this working capital financing. Okay, do you know what is committee form of organization? A group of people formed to make decisions, to give recommendations on the particular issues, that is called a committee. Okay. Regarding working capital, different committees were framed, set up in different periods. Okay. And here we have 4 committees: Tandon Committee, Tejia Committee, Core Committee and Marathe Committee. Okay. We will discuss each and every committee in the next slides. Next slide. First one is Tejia Committee. So Tejia Committee, the committee was set up during the year 1968. What is the objective of this committee? This committee examined the credit policies of the banks and their role in industrial development. Okay. And what are the recommendations? I already told you the committees where they form the committees to give some recommendations and suggestions. The suggestions given by the committee are: short-term credit should not be diverted to long-term assets. Okay. And banks should evaluate borrowers' total operational needs rather than relying solely on the security. Next, segregate the total credit needs into hardcore and short-term components Borrowers should be encouraged to maintain accounts with a single bank. Okay, these are the recommendations provided by the Tandon committee. The next committee we will discuss about the Tandon committee, and this committee was set up in 1974 and the chairperson for this committee named Tandon. That's why it is called Tandon committee. Okay, and what are the recommendations provided by the Tandon committee? Introduced the concept of maximum permissible bank finance and defined working capital as total current asset minus current liabilities. Okay, the working capital concept it is. And they suggested three methods for MPBF. First method, borrower contribute 25% of the working capital gap. Second method, borrower contribute 25% of total current asset. There is difference between working capital gap and current asset. And the third method is borrower fund core current assets entirely and 25% of the remaining asset. And it emphasizes the maintaining minimum current ratio. You know what is current ratio? Current ratio means current assets divided by current liabilities, and the ratio is 1.33:1. Okay, and next we are going to discuss about the core committee. Okay, and this committee set up during the year 1979. What is the objective for forming this committee? This committee is formed to streamline the cash credit limits and introduce discipline in working capital financing, and the recommendations listed here. Reduce the use of cash credit as the sole mode of working capital finance. Encourage businesses to diversify funding by using bills discounting. Banks to review limits periodically based on business activity levels. Promote credit discipline among borrowers. Okay, and the next committee, Marathe committee, the year it was set up during 1982. Okay, and the objective for the committee is address credit delivery for small scale industries and improve financing norms. And the recommendation by the committee, simplify the lending process of the small scale industries exercise. Introduce flexible working capital limits for small business. Okay, and this unit through 2, you have only 2 important questions, the committees and the approaches. Please concentrate on these 2 questions. You will get marks easily. Okay, and next we will move to unit 3, and the unit 3 is about cash management. Okay, introduction to cash management. You know very well what is cash, and the important liquid asset. Liquid asset you know very well. Okay, so one of the important liquid asset is cash, and it is very important to run the business. All the business require cash. Okay, next, what is cash management? Cash management refers to optimum utilization of cash to ensure liquidity and profitability of the business. Okay, and next one, what is the motive for holding cash? The business organizations holding cash, what is the motives behind the holding the cash? The first motive, it is called transaction motive. Transaction motive, it is required in business to operational expenses like utility bills, salary and wages, travel expenses, repair and maintenance, accounting expenses. All these are transactions, accounting transactions, you know very well. Okay, so the cash is required for these transactions. Next one, precautionary motive. Why? You know very well what is precaution. We take some actions before something happening. That is called precaution. Cash is required as provision to meet unexpected contingencies in the business. You cannot expect anything. Anything will happen anytime. So you have to hold cash for precautionary. Okay. Next one, speculative motive. Cash should be also kept to grab profitable opportunities of investment or profit booking as and when the prices are low or favorable. Okay. These are the motives behind holding cash in the business organization. Next one, cash budget. Okay, cash budget, you can expect a problem in cash budget. Okay, 10 marks cash budget problem. And you know very well what is budget. Budget means it is planning. Planning in numbers, it is called budget. You know very well in your home your mother or father will prepare budget. That is, it is planning how to spend the money, how to save the money. Okay, and in business organization, in national level, everyone is preparing budget. It is a planning. And here we have cash budget. What is cash budget? Cash budget is an estimation of the cash flows of a business over a specific period of time. Next we have the format of cash budget. Preparation of cash budget. I already told you for problem oriented paper you have to remember the format. This is the statement how you need to prepare cash budget. Okay, so you have to divide the columns. How many months they provide you, that number of columns you have to provide. If they give you 5-month details, you have to open 5 columns. Okay, and the first column it is for details, that is particulars. Okay, and the first part of the cash budget you have to write all the receipts. Remember, always you have to enter only the actual cash. If it is received, you have to enter. Okay, cash, if it is received physically, you have to record in receipts. And the second part of the cash budget, it is related to payments. Only if the payments were made, you have to record in the statement. Okay, and the difference between receipts and payments is the closing balance of the first month. You have to start with the opening balance. You have to add the receipts with opening balance, and you have to subtract the payments. You will get closing balance. Okay, and remember, the closing or balance of this month is the opening balance of the next month. Okay, and again you have to add receipts, find out the total of payments minus, then you will get the closing balance of the next month. That is the opening balance of the next month. Okay, this is the method you have to prepare cash budget. Okay, next we will see the cash management models. Okay, there are 2 cash management models, very important. You have to go through thoroughly for the examination. All the topics covered in this session, all the questions are important questions. Okay, and we have 2 models, the Miller-Orr approach and the Baumol's EOQ model. Okay, let us discuss what are the formulas for this model. First, I will explain you the Baumol's EOQ model. Okay, the formula used to calculate EOQ is C is equal to 2FT divided by I. And what is this C represents? C represents the optimum cash balance, and F represents the fixed transaction cost. T indicates the total cash requirement for that period, and I is the rate of interest during the period. Okay, and what it emphasizes? Emphasize on maintaining the optimum cash balance in a year to meet the business expenses on the one hand and grab the profitable investment opportunities on the other side. The next one, cash management model, Miller-Orr model. Now we will discuss the formula. Z is equal to root, and here you have to write cube. Okay, 3TV divided by 4I. Okay, and here we have the explanations for all this. What is Z, what is T, what is V, what is I. I already told you the formulas very simple. Using formulas you are going to solve the problems in working capital management. Don't forget the formulas. Easily you can solve the problems with formulas. Okay, and next we will move to unit 4, and unit 4 it is about receivables management. And let me explain what is this receivables management. Receivables represent amounts owed to the firm as a result of sale of goods or services in the ordinary course of business. The business organization, when they sell, okay, so they sell for credit, and the amount they get to receive, okay, that is called receivables. That is called receivables. Okay, the claims of the firm, we can call it as claims of the firm. Receivables are also known as accounts receivable. We can call it as account receivable, trade receivables, or book debts. Okay, these are alternative names for receivables. Okay, next, what is the cost of maintaining receivables? All the business organizations, they have to incur some cost for this receivables. The first cost is capital cost. There is a time gap between cost incurred and sales incurred. Okay. So funds to be raised for payment of wages and suppliers. We have a time period between the sales and cost. Okay. So we need to pay wages and suppliers. The liability to pay interest to creditors, opportunity cost incurred, the money the firm could have earned if invested outside the firm, it is capital cost. Next, cost of maintaining receivables. This is one of the costs. Okay. Administrative cost incurred for maintenance of customer accounts. All the business organizations have to maintain accounts. For that they incur some cost incurred for investigating the credit worthiness of the customer. I told you credit worthiness. What is credit worthiness? The ability to repay the loan, that is called credit worthiness. The next one is collection cost. What is this collection cost? Expenses for collection of payments from credit customers, cost of recovery from defaulting customers. These are included in the collection cost. And the last one is defaulting cost, that is bad debts. Okay, you know very well what is bad debts. And the aspects of receivables management. The first aspect of receivable management, it is the credit policy. Okay, what is the criteria the business organizations framed for credit, that is called a credit policy. Whether they are going to grant credit or not, what type of sales they plan to adopt, whether it is cash sales or credit sales, how much is the credit limit. That is, if they plan to give credit to the customers, they should fix the limit of amount. Okay, how much amount? Till 50,000. Likewise, each and every organization, they fix the limit for credit. This depends on the credit standards. Okay. Then next aspect, credit standards. Okay. These are the determinants. What already we have discussed. What is collection cost, average collection period, extent of bad debts, level of sales. These are the credit standards fixed by the organizations. And this is one of the related problem in receivables management. You can expect in 5 mark questions. Average collection period. What is this average collection period? It is average number of days it takes a business to collect payment from the customer after a sale or service has been made. Okay, and you have formula to calculate this average calculation period. Please, this is a simple formula. Don't forget the formulas. Okay, you can get marks easily. Simple problem only. Average collection period is equal to 365 divided by average receivables turnover ratio, and accounts receivable turnover ratio is equal to net credit sales divided by average accounts receivables. Okay. Then what are the credit terms? Some of the terms related to credits that we will see. Credit period. Credit period, it is the time for which the credit is extended. Okay. Some organizations provide a 3 months time. Some organizations provide 2 months time to repay the debt. Okay. That is called a credit period. And it depends upon the increase in sales volume, relaxed collection period, increase in bad and doubtful debts. Next term, credit term is cash discount. You know very well what is discount. Okay. Here we have one example, that is company A Limited. They deal with the cell phone and related accessories. And this is the example, one of the example for cash discount. This cell phone company, they provide their customers with the discount at 1%. Okay. Within 10 days, if they buy the cell phones in that particular organization, they will give 1% discount to the customers. This is one example for cash discount. Next, control of receivables. And the control of receivable, it depends upon the following. The collection policy already we have discussed. Monitoring receivables. The company has to monitor the receivables, manage the receivables. Day to day they have to monitor. Okay. And aging schedule. These are depends on this control of receivables. Next we will move to the unit 5. And the unit 5, it is related to inventory management. Inventory is nothing but the stock of the company. Okay. And what is inventory? Let me explain the meaning of inventory. Inventories means the stock of the product of your company and the components thereof that makes up the product. Okay. What are the examples for stock? Raw materials, work in progress and finished goods. These are the examples for inventory. Okay. And next, here we have the definition of inventory, and I already told you important 2-mark question. You can expect what is inventory or definition of inventory in your university question paper. Next, the objectives of inventory control. What is the objective? The basic objectives, 2 objectives: avoid over and under investment in inventories. The business has to maintain the correct inventory level. Okay, if the inventory level is very low, the production process will automatically stop. If they have excess of inventory, there is a possibility of damages, theft like. So the business has to maintain the level of inventory to provide a right quality goods at right time at proper value. Okay, these are the 2 main objectives of inventory control. And next, we will see what is inventory management, and there are inventory management techniques. Okay, so what are the techniques? ABC analysis, just in time, MRP, EOQ model, minimum safety stock, VED analysis, FSN method. These are all the techniques for inventory management. And now I am going to explain you each technique. What is this ABC analysis? The inventory items are classified into 3 categories. First category is highly expensive inventory. Second category is moderately expensive category, and the last one is least expensive category. Okay, so company keep the inventories in this order. Next one is just-in-time inventory method. The company keeps only that much of inventory which is needed during the production. They store only the required inventory, that is called just-in-time. For the time requirement, they are keeping inventory. Next one is MRP. MRP, what is the meaning of MRP? Material requirement planning. Okay, so this technique is placed after considering the sales forecast. Okay, so inventory, they maintain inventory after forecasting the sales. Next model, EOQ model. In this model, the store manager will order the inventory when it reaches the minimum level. Next one is minimum safety stock. It is the level of inventory which the organization needs to maintain to avoid out of stock situation. Okay. So next one is VED analysis. What is this VED analysis? Value, essential and desirable. Okay, this is called VED analysis. And last one is FSN method. F means fast, S indicates slow, and N means non-moving. Okay, this method is very useful for controlling obsolescence. Okay, and I hope everyone understand the concepts and formulas, the problems today I taught in the class. Thank you for your patient listening, and thank you.